I need to tell you something that's going to contradict everything you're hearing right now. While everyone is celebrating gold's meteoric rise, while the media is breathlessly reporting new record highs, while investors are pouring money into the yellow metal thinking they've found the ultimate safe haven, I see something very different. I see a warning sign, a flashing red light, a signal that we may be approaching one of the most significant market corrections of our lifetime. Now, I know what you're thinking. Warren Buffett has never liked gold. He's criticized it for decades. He famously said you could take all the gold in the world, melt it down into a cube, and it would just sit there doing nothing while businesses create value and farmland produces crops. And you're right. I've said all those things, and I stand by them. But this isn't about my personal feelings toward gold. This is about what gold's price is telling us about the state of the financial system. And right now, it's screaming that something is very, very wrong. Let me walk you through what I'm seeing, not through the lens of a gold bug or a doomsday prophet, but through the lens of someone who spent over 70 years studying markets, studying human behavior, and most importantly, studying what happens when asset prices become completely detached from any rational basis of valuation. You see, I've lived through every major market cycle since World War II. I remember the late 1940s when I bought my first stocks. I lived through the boom of the 1950s, the turbulence of the 1960s and 70s, the great bull market of the 80s and 90s, the dot-com bubble, the housing crisis, and everything since. And I can tell you from experience, when any asset, and I mean any asset, starts moving in a parabolic trajectory divorced from fundamental economic reality, it's not a sign of strength. It's a sign that we're in the final stages of a mania. Gold has gone from around $279 an ounce 25 years ago to over $3,500 today. That's more than a 1,200% increase. Now, on the surface, gold bulls will tell you this makes perfect sense. They'll point to money printing, to government debt, to geopolitical uncertainty, to the loss of confidence in fiat currencies. And superficially, those arguments sound reasonable. But let me tell you what's really happening and why this should terrify you rather than comfort you. First, let's address the elephant in the room. Why don't I own gold? Why has Berkshire Hathaway never held significant amounts of gold despite all the turmoil we've seen over the decades? The answer is simple. Gold doesn't produce anything. It doesn't grow. It doesn't innovate. It doesn't pay dividends. It doesn't hire workers or serve customers or create value in any meaningful way. It just sits there. Compare that to a productive asset. Let's take farmland as an example. If you buy a farm, that farm produces crops every year. Those crops can be sold. That creates income. You can reinvest that income into better equipment, better seeds, more efficient irrigation. The farm becomes more productive over time. 100 years from now, that farm will have produced decades worth of crops, fed thousands of people, and likely become even more valuable because of improvements made along the way. Or take a business. If you buy a good business, one with a strong competitive advantage, good management, pricing power, that business generates earnings year after year. Those earnings can be reinvested to grow the business, or they can be paid out as dividends to shareholders. Either way, value is being created continuously. 100 years from now, if it's a truly great business, it will have created enormous wealth for its owners. Now take gold. If you bought an ounce of gold 100 years ago and you bought another ounce today, you'd have 2 ounces of gold. That's it. Those 2 ounces would have produced nothing, earned nothing, created nothing. They would have just sat there inert and lifeless while the world around them changed and grew and prospered. So when people ask me why I don't own gold, that's why. It's not a productive asset. It's a speculation on fear and uncertainty. And while I understand that fear and uncertainty exist, I don't think betting on them is a good long-term strategy for building wealth. But here's where my analysis takes a turn that might surprise you. Even though I don't like gold as an investment, I pay very close attention to gold's price. Not because I want to buy it, but because gold's price tells me something incredibly important about what's happening in the broader economy and financial system. Gold is like a thermometer, and right now, that thermometer is showing a fever so high that it indicates the patient may be approaching a crisis. Let me explain what I mean. Gold doesn't have earnings. It doesn't have cash flow. It doesn't have a price to earnings ratio or a book value. So how do you value it? You can't, not in any traditional sense. Gold's price is purely a function of supply and demand, and more specifically, it's a function of how much faith people have in the alternatives, primarily fiat currencies and government bonds. When gold's price is stable and relatively low, it tells me that people have confidence in the financial system. They trust that their dollars will hold value. They trust that government bonds are safe. They're willing to put their money into productive assets because they believe the future will be better than the present. But when gold's price starts climbing rapidly, especially when it's climbing in spite of rising interest rates and a strong dollar and relatively stable economic conditions, it tells me something has fundamentally shifted. It tells me that large numbers of people, and more importantly, large institutions and even governments, have lost faith in the system. They're running to gold, not because gold is great, but because they think everything else is deteriorating. And that's what's happening right now. Gold isn't skyrocketing because it suddenly became more useful. It's skyrocketing because confidence in the alternatives is collapsing. And when confidence collapses, when fear takes over, when rational analysis is replaced by panic buying, that's when you get bubbles. And bubbles always end the same way. They pop. Now, let me walk you through the specific reasons why I think gold's current price is signaling an impending crash, not just in gold, but potentially in the broader financial system. First, let's talk about the dollar. The United States dollar has been the world's reserve currency since the end of World War II. After the Bretton Woods Conference in 1944, the dollar became the anchor of the global financial system. Every other currency was pegged to the dollar, and the dollar was pegged to gold at $35 per ounce. This gave the dollar credibility. It was as good as gold because it was backed by gold. But then in August of 1971, President Nixon closed the gold window. He announced that the United States would no longer convert dollars into gold at a fixed rate. This was a watershed moment. For the first time in history, the world's reserve currency was backed by nothing but the full faith and credit of the United States government. Now, you might think this would have immediately destroyed confidence in the dollar, but it didn't. Why? Because the United States was still the world's largest economy. It had the most powerful military, it had the most dynamic business sector, it had the deepest capital markets. In short, even without gold backing, the dollar was still the best option available. And for 50 years, that remained true. Oh, sure, we had periods of dollar weakness. The late 1970s were particularly bad, with inflation raging and gold hitting an inflation-adjusted peak of over $2,000 per ounce. In 1980, but then Paul Volcker came in as Federal Reserve Chairman, raised interest rates to punishing levels, broke the back of inflation, and restored confidence in the dollar. Gold crashed, falling from over $800 in 1980 to under $300 by 2000. That episode taught me something important. Gold's price isn't just about monetary policy or inflation. It's about confidence. When confidence in the system is restored, gold falls. When confidence erodes, gold rises. And right now, confidence is eroding at a pace I haven't seen since the 1970s. But here's the crucial difference between now and the 70s. Back then, the erosion of confidence was fixable. We had the political will to raise interest rates, to endure a painful recession, to do whatever was necessary to restore faith in the dollar. Today, I'm not sure we have that same will, and the markets know it. Look at what's happened over the last 20 years. After the dot-com bubble burst in 2000, the Federal Reserve slashed interest rates to 1% and kept them there for years. This created the housing bubble. When that bubble burst in 2008, the Fed's response was even more extreme. They didn't just cut rates to zero. They invented quantitative easing, creating trillions of dollars out of thin air to buy bonds and mortgage-backed securities. Then came the pandemic in 2020. Once again, the Fed's response was to print money on an unprecedented scale. The Fed's balance sheet exploded from $4 trillion to nearly $9 trillion in a matter of months. The federal government sent checks directly to individuals and businesses. We created more money in 2 years than we had in the previous 200 years of American history. Now, you might say, well, Warren, we had to do that. We were facing a global crisis. And I'm not here to argue about whether it was necessary. My point is simply this. We've now established a pattern. Every time we face a crisis, we print money. We don't raise taxes. We don't cut spending. We don't make hard choices. We just print money and hope for the best. And here's what the gold market is telling us. It's telling us that the world has noticed this pattern. It's telling us that central banks, sovereign wealth funds, and large institutional investors have looked at this track record and concluded that the dollar's purchasing power is going to continue eroding indefinitely. So they're buying gold not as a speculation, but as insurance against what they see as the inevitable debasement of paper currencies. But, and this is a big but, they're making a crucial mistake. They're assuming that because gold has held its value for thousands of years, it will continue to do so forever. They're assuming that the current price of gold represents fair value for that insurance. And I'm here to tell you, it doesn't. Let me give you some numbers to illustrate what I mean. The total value of all the gold ever mined in human history is roughly $14 trillion at current prices. That's a lot of money. But compared to the total value of global stocks, which is around $100 trillion, or global real estate, which is around $300 trillion, or global debt, which is over $300 trillion. In other words, gold represents a tiny fraction of global wealth, yet its price is being driven by a relatively small number of buyers, primarily central banks and large institutions, who are buying for the same reason at the same time. This is creating artificial scarcity and driving the price to unsustainable levels. Think about what happened in the late 1970s. Gold hit $850 an ounce in January of 1980. Adjusted for inflation, that's equivalent to around $3,000 in today's money. And we're already past that level. But here's what happened next. Gold crashed. It fell 70% over the next 20 years. Why? Because the reasons people were buying gold, mainly fear of inflation and currency collapse, didn't come to pass. Paul Volcker tamed inflation, the economy stabilized, and everyone who bought gold at the peak was left holding an asset that generated no income and had lost most of its value. Now, I'm not saying we're going to see Paul Volcker 2.0 come in and raise rates to 20%. That's not realistic given the levels of debt in the system. But I am saying that gold's current price is based on an extreme scenario that may not play out the way people expect. Here's another way to think about it. Gold bugs will tell you that gold is rising because central banks are buying it in record amounts. China, Russia, India, and other countries have been accumulating gold at a pace not seen in decades. And this is true, but ask yourself why. These countries aren't buying gold because they think it's a great investment. They're buying it because they're trying to diversify away from dollar-denominated assets. They see the same things I see. Massive government deficits, unsustainable debt levels, and a Federal Reserve that seems more willing to print money than to make hard choices. So they're reducing their holdings of U.S. Treasury bonds and buying gold instead. But here's the problem with that strategy. If you're a central bank and you convert $1 trillion worth of Treasury bonds into gold, you've solved one problem but created another. You're no longer exposed to potential dollar devaluation, but you're now holding an asset that pays you nothing that you can't easily sell without moving the market. And that could lose significant value if sentiment shifts. And sentiment always shifts, always. That's the nature of markets. The pendulum swings from fear to greed and back again. Right now, we're at an extreme of fear, at least when it comes to faith in fiat currencies. But that fear won't last forever. At some point, something will change. Maybe inflation will come down more than expected. Maybe a new political leadership will emerge with the credibility to make tough fiscal choices. Maybe a technological breakthrough will boost productivity and economic growth in ways we can't currently imagine. When that happens, when the sentiment shifts from fear back to optimism, all those central banks and institutions that bought gold at $3,000 or more are going to find themselves sitting on massive losses. And unlike a business that can adapt and innovate, unlike farmland that keeps producing crops, gold will just sit there, worth less than they paid for it, generating nothing. This is why I've always preferred productive assets to gold, not because I'm blind to the risks in the financial system. I see those risks more clearly than most, but because I believe that over long periods of time, productive assets will always outperform non-productive assets, always. Let me give you a concrete example. In 1942, I bought my first stock. I was 11 years old, and I used my savings to buy 6 shares of City Service Preferred at $38 per share. The stock quickly dropped to $27, and I was terrified. But I held on and eventually sold at $40 for a small profit. It was my first lesson in the stock market, and it taught me something crucial. If you buy a good asset at a fair price and give it time, it will reward you. Now, imagine if instead of buying that stock, I had convinced my parents to buy gold for me. In 1942, gold was fixed at $35 per ounce. If I'd bought 1 ounce and held it until today, I'd have 1 ounce worth about $3,500. That's a 100-fold return, which sounds impressive. But that original stock investment, if I'd held it and reinvested the dividends and made similarly sound investments over the following decades, would be worth tens of millions of dollars today. Why? Because businesses grow, they compound, they create value year after year after year. Gold does none of that. And this gets to the heart of why gold's current price is so dangerous. It's not just that gold is overvalued, it's that people are making portfolio allocation decisions based on fear rather than rational analysis. They're pulling money out of productive assets that generate real returns and parking it in a non-productive asset that does nothing. This is wealth destruction on a massive scale. Now, let's talk about what I think is going to happen. I don't have a crystal ball, and I've learned over the years to be humble about making short-term predictions. Markets can stay irrational longer than you can stay solvent, as the saying goes. But I can look at historical patterns and probabilities, and I can tell you what I think is likely. First, I think gold's price is going to continue rising in the short term. Why? Because fear feeds on itself. As gold goes higher, more people see it as validation of their fears. More institutions feel pressured to buy it to keep up with their peers. More media coverage portrays gold as the only safe haven. This creates a feedback loop that can push prices far beyond any rational level. We saw this in the late 1970s. We saw it with tech stocks in the late 1990s. We saw it with housing in the mid-2000s. And we're seeing it with gold right now. These manias always end the same way. They reach a peak, usually when the last skeptics finally capitulate and start buying, and then they reverse. The reversal can be triggered by almost anything. A change in interest rates, a shift in geopolitical tensions, a statement by a central bank, an unexpected economic report. The trigger itself doesn't matter. What matters is that once the price starts falling, all those people who bought because everyone else was buying suddenly panic. The feedback loop goes into reverse. Fear of losing money replaces fear of missing out, and the selling becomes a stampede. When will this happen with gold? I don't know. It could be next month. It could be next year. It could be 5 years from now. But it will happen. It always does. And when it does, the people who bought gold at $3,000 or more are going to experience losses that will take decades to recover from, if they ever do. Now, you might be thinking, Warren, you're just talking your book. You don't own gold, so of course you want to scare people away from it. But that's not what this is about. I'm not trying to get people to sell gold so I can buy it cheap. I have no intention of ever owning gold in any significant amount. What I'm trying to do is warn people, especially ordinary investors who don't have the resources to weather a major loss, that what looks like safety right now might actually be extreme danger. So let me tell you about the people I worry about most. It's not the central banks or the billionaires who can afford to be wrong. It's the retirees who worked their whole lives to save a modest nest egg and who are now being told by financial advisors or YouTube videos or their brother-in-law that they need to put 20 or 30 or even 50% of their portfolio into gold to protect themselves from the coming collapse of the dollar. These people are being sold a bill of goods. They're being told that gold is safe when in fact, at current prices, it's one of the riskiest assets they could own. And when the inevitable reversal comes, they're going to lose a substantial portion of their life savings at a time when they have no ability to earn it back. This makes me angry because it's so unnecessary. There are perfectly good ways to protect yourself from currency devaluation and financial instability without buying gold. You can own businesses with pricing power that can raise their prices along with inflation. You can own real estate that generates rental income. You can own infrastructure assets like utilities and pipelines that have regulated returns. You can own Treasury inflation-protected securities that adjust their principal based on changes in the consumer price index. All of these assets provide protection against the risks that gold buyers are worried about. But unlike gold, they also produce income. They have intrinsic value. They serve a purpose in the economy. They make you money while they protect you. But none of these sensible alternatives are sexy. They don't have the mystique of gold. They don't let you feel like you're part of an exclusive club of people who really understand what's going on. And so people ignore them in favor of an asset that has captured their imagination and their fear. This is a huge mistake, and the size of the mistake is proportional to gold's current price. If gold were at $1,000 per ounce right now, I'd still think it was a poor investment, but at least the downside would be limited. At $3,500 per ounce, the downside is enormous. Let me share with you what I think is the most likely scenario over the next decade. I think we're going to continue to see volatility in the financial markets. I think government debt levels are going to continue to rise. I think we're going to have periodic crises that scare investors and make them question the stability of the system. All of this is true, and I'm not trying to minimize it. But I also think that the American economy and the global economy more broadly is far more resilient than the gold bugs give it credit for. We've been through worse crises than this and come out stronger. We went through the Great Depression and World War II. We went through the stagflation of the 1970s. We went through the near collapse of the financial system in 2008. And every time we've adapted and recovered. Why? Because of human ingenuity, because of innovation, because of the profit motive that drives people to find solutions to problems, because of the incredible productivity of modern capitalism, which despite all its flaws, has lifted more people out of poverty and created more wealth than any system in human history. None of that innovation, none of that problem solving, none of that wealth creation happens in gold. It happens in businesses. It happens in technology companies that figure out how to do things faster and cheaper. It happens in pharmaceutical companies that develop new treatments for diseases. It happens in energy companies that find new sources of power. It happens in agricultural companies that feed a growing global population. These are the things that drive real economic value. These are the things that compound over time. And these are the things that over the long run will far outperform gold. So when I look at gold's current price, I don't see a safe haven. I see a speculative bubble driven by fear and extrapolation. I see people making the same mistake that investors always make at market peaks, assuming that the recent past is a reliable guide to the future. I see a mania that will end badly for most of the people participating in it. And I see something else that concerns me even more. I see gold's price as a signal that confidence in the broader financial system is breaking down. And while I don't think that confidence is justified in breaking down, the fact that it is breaking down creates its own set of problems. When people lose faith in institutions, when they stop trusting the system, when they start hoarding gold and preparing for collapse, they can actually help bring about the very collapse they fear. This is the self-fulfilling prophecy problem. If enough people believe the dollar is going to become worthless, they'll get rid of their dollars. This increases the velocity of money, which increases inflation, which makes the dollar worth less, which validates the original fear and creates more selling. It's a vicious cycle that can spiral out of control if it's not interrupted. The only way to interrupt it is to restore confidence. And the only way to restore confidence is to demonstrate that the people running the system are capable of making hard choices and solving real problems. That means addressing the deficit. That means reforming entitlement programs. That means having honest conversations about trade-offs and priorities. That means electing leaders who are willing to tell people things they don't want to hear if those things are true. I'm not optimistic that we're going to see this kind of leadership in the near term, but I am optimistic that eventually we will, because the alternative is too painful. When the crisis becomes acute enough, when the pain becomes sharp enough, people find a way to come together and solve problems. They always have, and I believe they always will. But in the meantime, we're going to have to navigate a very difficult period. And for investors, that means being smart about how you position your portfolio. It means not getting caught up in the mania of the moment, whether that mania is in gold or tech stocks or anything else. It means sticking to the fundamental principles that have worked for decades. Buy good businesses at fair prices. Hold them for the long term. Don't try to time the market. Don't let fear or greed drive your decisions. Invest in things you understand. Make sure you're getting paid to take risks through dividends or earnings or cash flow. Stay diversified across different sectors and asset classes. And above all, maintain a long-term perspective. These principles sound boring. They are boring, but they work. They worked for me for over 70 years. They've worked for countless other successful investors, and they'll work for you if you have the discipline to follow them. Gold is the opposite of this approach. Gold is exciting. Gold is dramatic. Gold lets you feel like you're taking action, like you're doing something important to protect yourself. But it's an illusion. You're not protecting yourself by buying an overpriced, non-productive asset. You're exposing yourself to significant risk. Now, I want to address one more argument that gold advocates make. They say that even if gold doesn't produce anything, it has value because governments and central banks hold it. They say that gold is money, and it always will be, because it has thousands of years of history behind it. This argument has some merit, but it's not as strong as people think. Yes, central banks hold gold. As of today, central banks collectively hold about 35,000 tons of gold, worth roughly $2 trillion. That's a lot, but compare that to the over $100 trillion in total central bank assets worldwide. Gold represents less than 2% of total central bank reserves. Moreover, the reasons central banks hold gold have more to do with tradition and psychology than with economic logic. Central banks hold gold because other central banks hold gold. They hold it because their citizens expect them to hold it. They hold it as a hedge against extreme tail risk scenarios. But they don't hold it because it's a good investment or because it serves any productive purpose in the economy. And here's the thing. That tradition could change. In fact, it's already changing. Look at what happened in the late 1990s and early 2000s. Several European central banks, including the Bank of England and the Swiss National Bank, sold significant portions of their gold reserves. They decided that gold was a relic, that it was better to hold interest-bearing assets like government bonds, and they were right. The gold they sold at $300 per ounce was a terrible investment compared to the bonds they bought instead. Now, you might say, well, Warren, those central banks look foolish now that gold is over $3,000. But that's hindsight bias. At the time, their decision was rational. And more importantly, if central banks could decide to sell gold, then they could decide to sell it again in the future. There's nothing magical about gold that makes it a permanent store of value. Its value is entirely dependent on human psychology and convention, both of which can change. This is why I say gold has no intrinsic value. A business has intrinsic value because it produces goods and services that people want. Farmland has intrinsic value because it grows food. A bond has intrinsic value because it's a legal claim on future cash flows. But gold has value only because people believe it has value. And when that belief changes, the value evaporates. We've seen this happen with other assets that people once thought were permanent stores of value. In 17th century Holland, tulip bulbs became a mania. People convinced themselves that rare tulip varieties were incredibly valuable, and prices rose to insane levels. At the peak, a single tulip bulb could cost more than a house. Then the mania broke, and the bulbs became worthless, not because tulips stopped being pretty, but because people realized they'd been valuing them based on speculation rather than any real utility. I'm not saying gold is going to go to zero like tulip bulbs did. Gold has more lasting cultural significance than tulips. But I am saying that gold's current price is based far more on speculation and fear than on any rational assessment of its utility. And prices that are based on speculation and fear are inherently unstable. Let me give you one final thought experiment. Imagine that tomorrow a scientist discovers a way to synthesize gold cheaply and easily from common elements. Suddenly, there's an unlimited supply of gold. What happens to the price? It crashes to whatever the production cost is, probably a few dollars per ounce. All those people who bought gold at $3,000 would lose everything. Now, this scenario is unlikely with current technology, but it illustrates an important point. Gold's value is based on scarcity, not on utility, and anything whose value is based primarily on scarcity is vulnerable to changes in supply, changes in demand, or changes in people's perception of its importance. Compare this to a great business. If someone figures out how to make cheaper cars, it doesn't destroy the value of Ford or Toyota. They adapt. They find new ways to create value. They innovate. The business survives and thrives because it's doing something useful, something people want, something that solves real problems. Gold solves no problems. It just sits there, glittering and inert, waiting for someone to decide it's valuable. And when enough people decide it's not, when the fear subsides and rationality returns, gold's price will fall. Not to zero, but certainly far below current levels. And the people who bought at the peak will be left wondering how they could have been so foolish. This is my warning. This is what I see when I look at gold's price today. Not opportunity, not safety, but danger. The danger that comes from extreme valuations based on emotion rather than analysis. The danger that comes from people abandoning productive assets in favor of non-productive ones. The danger that comes from believing that this time is different, that the old rules don't apply, that gold's rise will continue forever. It won't. It never does. And the longer the mania goes on, the harder the fall will be when it finally ends. That's not pessimism. That's not being negative. That's just reality based on decades of watching markets and studying history. Manias end, bubbles pop, and the people who bought at the top suffer the consequences. So what should you do? If you own gold, I'd suggest thinking very carefully about why. If it's a small part of your portfolio, 5 or 10%, as a hedge against extreme scenarios, fine. I still think it's unnecessary, but it won't kill you. But if gold represents a large portion of your wealth, if you've put your retirement savings or your children's college fund into gold because you're convinced the dollar is about to collapse, I'd urge you to reconsider. You're taking far more risk than you realize. Instead, focus on owning pieces of good businesses, companies with strong competitive advantages, companies with pricing power that can pass inflation through to customers, companies with low debt levels and strong balance sheets, companies run by honest, capable management teams who are focused on long-term value creation rather than short-term stock price manipulation. These businesses will survive whatever turbulence lies ahead. They'll adapt to changing circumstances. They'll find ways to serve customers and generate profits. And over time, they'll compound your wealth in a way that gold never can. That's the path to financial security. Not hoarding metal in a vault, not betting on collapse and chaos, but investing in human ingenuity and productivity, betting on the future rather than against it, having faith that despite all our problems and challenges, people will find ways to solve them and move forward. I've bet on America and American business for over 70 years. And that bet has paid off beyond my wildest dreams. Not because I'm smarter than everyone else, not because I had inside information, but because I followed simple principles, stayed patient, and trusted in the long-term trajectory of human progress. That trajectory has always been upward, even though the path has been anything but smooth. And I believe it will continue to be upward, even though we'll face many more challenges and crises along the way. The key is not to lose your head when everyone around you is losing theirs, not to abandon sound principles when fear is at its peak, not to chase whatever asset happens to be rising at the moment without understanding why it's rising or what might cause that rise to reverse. Gold's current price is a warning sign. It's telling us that fear is overwhelming reason. It's telling us that people are making decisions based on emotion rather than analysis. It's telling us that we're in the late stages of a mania that will end badly for many participants. Don't be one of those participants. Stick to the fundamentals. Own productive assets. Stay disciplined. Think long term. And remember that the best time to be fearful is when others are greedy, and the best time to be greedy is when others are fearful. Right now, with gold, others are fearful. They're running to gold as a refuge. And that tells me it's time to be cautious about gold, not enthusiastic about it. History will prove this. Warning, correct. I just hope enough people hear it before they learn the lesson the hard way.